I suspect you're going to see gold at minimum do what it's done before, twice, have an eightfold move. Right now, silver's barely above the highs of the last 50 years when you put it on a percent scale. The dimension of that range, tenfold move, $5 to 50, it's 50. Take the dimension of that and add it to the top. What's tenfold over 50? 500. Oh, equal move, ratio scale. Heck, gold's done that several times, increase in the supply of money. It's a junior Weimar Republic.
They're going to look at gold and they're going to say, my goodness, 5,000, 6,000, 7,000.
Fully puncture any positive emotion among the average Joe with his retirement account, saying to his wife, they're both 60s, and they got just enough to retire. If you snap 30% of that away because of the stock market, initial bear market, all of a sudden it's gloom. You'll have layoffs. Unemployment, the panic mode for the central banks gets accelerated here. When you have the house burning, but government debt in doubt, no longer what it used to be, they have to print.
Explain why your price calls really should be taken seriously and what these investors and analysts who are bemoaning them, what they're missing.
Realities. Okay. Take a look at, think about this as sanity or insanity. Silver stuck in a 50-year price range with two peaks at $50, 1980, 2011. Gold during that same 50-year period since 1980, which is basically a high for most metals. Gold made a high then, silver made a high at 50. Gold was at 850, 1980 now. Okay. And has had pullbacks and advances, but gold has continued upward. It's 4.5 times where it was, at the start of this. Where silver is only, $16 above the high of the $50 peak range, 15% higher than it was 50 years ago, 56 years ago. Look at copper, look at lead, look at zinc, look at steel. They're 4 times. Copper 6 times its price level of 1980. What's going on with silver? How come it isn't matching the other monetary metal, which is 4.5 times where it was then? Or copper, which is 6 times where it was then? Or, all these other base metals. And yet it's even had a supply-demand deficit for 6 years now. And yet it's still barely above the top of the box. Now, either that's justified for some unknown, bizarre, crazy reason, or it's been manipulated, as many argue, and I think it's a good case. But still now, in late last year, it said, hey, I'm PO'd. I'm coming out of here. And so it went nuts.
Silver's biggest warning may be that it still looks cheap after everything else has already repriced. Michael Oliver notes that silver remains barely above a 50-year ceiling, while gold is roughly 4.5 times higher than its 1980 level, and copper about 6 times higher. That divergence is difficult to dismiss when silver has also faced years of supply deficits. For investors, the question isn't whether silver moved, it's why the historical gap remains so enormous. Next, Michael Oliver exposes what that broken range could signal about silver's next phase.
For 6 weeks or so, late last year into late January this year. And it was the first ventilation of this half-century range. And that's the end of it? Merely doubling the price level a little bit more than where it was for 50 years, whereas copper's 6 times, steel's 4, et cetera, et cetera. Something's bizarre is going on there. Now, we argue technically that silver is now in the process of catching up. Not only to where the base metals are versus 50 years ago, but gold, 4.5 times right now where it was 50 years ago. It's going to catch up. And it's going to do it in a tantrum manner. We think that tantrum only was indicated late last year into January. It was the first sign of, ventilation. Okay. The old reality just got broken. And so it had a party. But the problem was what? MSA, for example, has given 3 major long-term buy signals in silver since 2023. We had way back in 16 as well. But 2023, price was approaching $26. Major buy signal, annual momentum. June 2025, silver had been stuck in a range for a year, was approaching top of that range around $35. It was our second major buy signal before it even broke out of that range. And then at $56 as of the November close last year, when its spread versus gold broke out, favoring silver. So we had three major buys, but most of the crowd that bought silver recently and paid dues for it were what?
The painful part of a breakout is realizing the market may have warned you long before the crowd arrived. According to Michael Oliver, major silver buy signals appeared near $26 in 2023, around $35 in June 2025, and near $56 later that year. The important distinction is timing. Institutions following momentum weren't necessarily chasing the eventual surge at much higher prices. Retail investors who entered after headlines exploded accepted far greater risk. Next, Michael Oliver reveals why arriving late can make a correct thesis feel completely wrong.
They probably bought it at 100, 110, 120. And so naturally, they're PO'd. Okay, we don't suggest you buy high. We suggest you buy at appropriate points. We could talk about the next one in a minute. But that's one of the problems with too many market observers. They came in late and they got the hell kicked out of them. And, not that the trend wasn't right, but they came in at the wrong time.
So you're seeing the metals starting to move again. You're seeing this is likely the start of a new bull leg. Are you expecting a wave of selling from doubters of the price movements in gold and silver at some point coming up? Here, like let's say, we've seen this initial move off the bottom by gold and silver from 4,000 to 44, 4,500 for gold, and from 55 or 54 for silver.
Yeah.
Yeah. Are you expecting a wave of selling to come at some point?
We're expecting what we define as a wobble, meaning, bad week. But the bad week, we're not at the levels where we think the bad week will occur. Whereas I don't think silver and gold are going to go up and zap out the highs right now. They may do it in the next month or so. But in this particular surge that started by our metrics 2 weeks ago, first days of August, we broke through massive momentum structures that said, you're born again. Okay.
The danger isn't that silver's thesis failed, it's that late buyers confuse momentum with timing. What Michael Oliver is highlighting is that investors buying near $100, $110, or $120 entered after major signals appeared. That doesn't invalidate the trend, but it changes the risk-reward equation. Wealth preservation means respecting entry points when emotional buying follows a vertical move. Next, Michael Oliver exposes the wobble levels that could shake out latecomers before the advance.
And we've since shot up nicely. Okay. Mm-hmm. We don't think it's going to stop until you get gold up to around 4,750 to 4,800. There might be a wobble there. Again, if you're long, don't get out there. This is a teaser. This is a place where the doubters come in again and say, see, it's no good. I'm going to sell it. Because the prior two rallies didn't take hold either, did they? Right? Two rallies since the top. This one's going to take hold, but you're going to get a wobble. Now, silver, I think wobble could be upper 70s near 80, where it gets its little shin kicked, but a very brief phenomenon. But the kind of thing that would attract public attention, and the doubters could say, see, I told you it's no good. Okay, we're going back down again. It's going to be here for years. Okay. Similarly with the miners, we have certain levels that are not even near right now that they could have a wobble. We're only about halfway toward the wobble point. But once that wobble is come and gone, that's when I think then you advance. And that's when all the doubters say, well, damn, I thought we were going to be here for a couple of years. I thought that was the 1980 top, And it's at some point after that level that we're going to accelerate at levels that we've not seen even in the late last year and early this year.
A temporary metal sell-off could test whether this rally has real staying power. Michael Oliver's argument suggests gold may approach $4,750 to $4,800 before a wobble, while silver could face resistance near $80. That matters because corrections often produce headlines declaring the bull market finished even when the structure remains intact. Investors must distinguish volatility from genuine reversal. Next, Michael Oliver reveals why the shakeout could strengthen the advance despite the noise,
which appeared to be dramatic. But when you put it on a percent scale, which people need to do, because when you're dealing with markets that are now 4 or 5 or 6 times higher than they were in 1980, putting them on an arithmetic scale is distortion. You need to see the ratio move. Right now, silver's barely above the highs of the last 50 years when you put it on a percent scale. If we were merely take the dimension of that range of 50 years was $5 to 50, let's call it. Okay. Tenfold move, $5 to 50. It's 50. Take the dimension of that and add it to the top. What's tenfold over 50? 500. Okay. If you went to 500 right now, you would have equal move ratio scale. Heck, gold's done that several times. Look at the base metals. I think that's likely where minimum you're going to see. And I think you're going to see it so quickly, not a full year, but more like a half a year. You're going to get from out of this range to something at that level, if not a lot higher even. Because getting up, for example, to 500 silver would merely put it catch up to where the base metals are now and gold is now on a ratio basis. They're not going to sit here and silver go up. They're going to actually advance some more as well. The base metals are in advance mode. Gold is definitely in one.
The biggest mistake investors make is judging a secular metals move by a one-year chart. This is where Michael Oliver's thesis shifts. Silver reaching $500 would not necessarily be absurd when measured against historical percentage expansion and other metals repricing. The crucial comparison is relative, not nominal, because gold and copper dramatically outpaced silver since 1980. For savers, that gap could matter more than headline price. Next, Michael Oliver exposes why percentages change silver's valuation.
And I suspect you're going to see gold at minimum do what it's done before, twice, have an eightfold move. The peak in 1980 from the 76 low was eightfold. 2001, 2002 pullback low to 2011, eightfold move. Right now, we're only a little bit more than fourfold.
So let me ask you this: these are large moves, not that they have never happened, and a lot of people are expecting this over a period of time. But I think the question is, what does life look like? With copper, silver, gold, other base metals, being much more elevated, not 10, 15, 20% elevated, but hundreds of percent elevated from where they are today. What does life look like? What does the economy look like? What does the everyday life look like for the normal person here in the States?
Well, monetary metals will lead the commodity complex in terms of percent gain, and they don't always move together. You look at like the Bloomberg Commodity Index, there are plenty of times where multiple years the Bloomberg will go down, like from 2015 to 20. It went down. Gold doubled during that time. Silver also went up a lot. I think think about it this way. There's printing of money by the central banks. And if you look at an M2 chart from the Fed, you'll see this parabolic, lovely chart. You just wish you were along that thing, so great. It reflects the degradation in the money unit by simply...
Gold's previous monster advances suggest today's move may be earlier in the cycle than investors assume. Michael Oliver notes that gold advanced roughly eightfold from the 1976 low into 1980, and again from the 2001 to 2002 low into 2011, while today's move is only fourfold. That challenges assumptions that the cycle is exhausted. If metals keep outperforming, portfolios could face a different inflation landscape. Next, Michael Oliver reveals where expanding money supply pushes capital.
Increase in the supply of money. It's a junior Weimar Republic. Okay. That money goes places. A lot of times it'll go to the stock market. And when the stock market decides, hey, I've had enough, it goes down, it goes somewhere else. It usually goes into bonds and gold. If you go back and look at those spans of time when the stock market was in a bear, for most of those trends, gold was going the opposite way. There might have been a bad month here or there, but basically opposite. So now you have a situation where we have a bubble market here, and in some other parts of the world, Japan in particular, a bubble stock market. Should that beast break, and we think it's going to, and join the bonds, which are no longer an alternative, you as an investor, there's this massive flow of money, even more than we've had lately, because the panic mode for the central banks gets accelerated here. When you have the house burning, the government house burning, not your mortgage, but government debt, in doubt, no longer what it used to be, they have to print. And, just as the Fed has done recently, help support the yen, printed money, so the Japanese wouldn't dump more of our bonds. Okay, that goes somewhere. And so that's the philosophy, the underlying explanation of why will such assets as things in the ground and grown on the surface of the ground suddenly rise in value relative to paper assets that have been bloated.
That makes sense. But what happens to inflation?
The market can hide monetary deterioration for years by pushing new money into financial assets first. According to Michael Oliver, when stocks weaken, capital can migrate toward bonds, gold, and commodities, especially when central banks add liquidity. That creates a contradiction. Policymakers may stabilize markets while weakening purchasing power. For households, the risk is purchasing power loss while seeking safety. Next, Michael Oliver exposes why inflation could accelerate after the next major shock.
What happens to everyday life for the average American?
Very bad, because naturally, if the economy turns south, which it will if the stock market turns down, and I think it is about to, we've got specific numbers that we identify, that will fully puncture any positive emotion among the average Joe with his retirement account, saying to his wife, they're both 60s, and they got just enough to retire. If you snap 30% of that away because of the stock market, initial bear market, all of a sudden it's gloom. You'll have layoffs. Unemployment data, for example, that the Fed likes to point to as a metric is baloney. It turns south, unemployment numbers turn south, usually well after the stock market has already dropped like 20% off its high. Then suddenly that data point gives the Fed justification. Well, they know better, but they argue that no, everything's looking good. Okay, fine.
Is this your base case that we're going to see recession, stock market drop, and an unemployment event?
I think you're going to see the global stagflation like we saw in the late 70s, except this time it's going to be government debt crisis, which we have not had in any of our major bear markets and stocks. We've not had a government debt crisis. It's not just Japan. Now it's us. And you can bet it'll be Europe and UK shortly. They've got the same problems.
A stock market crash could hurt retirement accounts before unemployment data confirms the recession. What Michael Oliver is highlighting is the lag between market weakness and official labor indicators, so policymakers may react after portfolios fall. If governments face debt stress and print money, the result could resemble stagflation. Investors should recognize cash can become purchasing power risk. Next, Michael Oliver reveals why government debt changes this cycle. Crucially,
that can't be withstood. You can't take that. It's a nuclear event. It wipes everything off the table in terms of your assessment of what's going to happen or what's reality. And that's what we're facing this time. And once that money flow increases, which it will, because they have to put out the fire, but it doesn't go into the stock market, which it does usually when they try to put out the fire, like the .com thing or the mortgage. Stocks went down anyway. The money went elsewhere. And if you look at the relative value of base metals or commodities in general compared to the stock market, they're off the page cheap.
Okay, so as gold and silver are rising, especially gold, because gold is already over $4,000 an ounce. It's close to 4,500. It's going to eventually take out that high, as you see it, that we had in January, 5,500, and go up from there. Investors are going to be pulling their money, rotating out of whatever they're in, financialized assets, and trying to get into hard assets. They're going to look at gold and they're going to say, my goodness, 5,000, 6,000, 7,000, and all I get is this little coin. But look at these miners over here. I can get more value for these miners for my dollars. Is that how you see it? Do you see the
Absolutely.
rotation?
Yeah.
The next commodity surge may come from capital escaping financial assets. Michael Oliver's argument suggests that when stocks and bonds lose credibility, investors may seek tangible assets whose supply cannot be expanded. Gold breaking highs could redirect attention toward miners. That rotation could reshape portfolios before mainstream commentary catches up. Next, Michael Oliver exposes the miner to gold relationship that may signal when rotation begins. This could change allocation decisions.
In fact, right now, the most important technical signal that we can produce, and we think should be on the front page of the Wall Street Journal, is one that when it occurs, it's not a price-based or momentum-based for gold and silver. It's a relationship between the miners and gold. And you've got that chart, I think. But
Yeah,
the
let me
point
pull
is
that up.
that you made a good point about the miners.
Can you see that?
This is GDX. Okay, now this is also true with XAU versus gold. But back in the 1980s through 2008, GDX, for example, was up in the 6-7% zone. It only started trading in 2006. But XAU has a similar chart that has collapsed, just like this one collapsed in 2013 through 15. The valuation of the miners, and what we do here is we simply take the price of GDX, and each month we close, we divide that price into the price of an ounce of gold, and it's a certain percent. Well, in the case of GDX, it was up at their 6.5% or so. XAU was up at 25% roughly at that time. XAU spread versus gold dropped from 25% average price for decades, so average relationship to gold, to 4%. And this one, which had been 6.5 and had more history, it had been up at 7 or 8 if you'd gone back further, but there was no history, dropped down to about 1%. I mean, what do you think the miners are going to do? Go to zero?
The revealing metal signal may not be gold's price, but how cheaply miners trade. This is where Michael Oliver's thesis shifts toward valuation. Historical miner to gold relationships stood higher, while today's ratio remains compressed after underperformance. Rising bullion prices could force investors to reconsider whether mining equities are mispriced. For portfolio holders, the question is whether this discount reflects weakness or distortion.